Retirees in 12 states are now facing a new tax on Social Security benefits. Are you one of them? You spent decades paying into the system, but depending on where you live, the state can still take a bite out of your check. Most people never see it coming, and the shock hits the moment your payment arrives smaller than you expected. This isn't just a minor deduction for many, it's hundreds of dollars a year gone. So before we reveal the 12 states, you need to understand why your Social Security check isn't fully safe to begin with. Chapter 1. The Federal Tax Trap. You probably thought your Social Security check was yours, free and clear. After all, you worked for decades, paid into the system, and now it's supposed to be your turn. You waited, you planned, and you earned those benefits. But here's the first shocker: even before your state gets involved, the federal government can tax up to 85% of your Social Security benefits. It all comes down to something called combined income. This isn't just your Social Security check. It's your adjusted gross income plus any tax-exempt interest plus half of your Social Security. Add it all together, and suddenly you're pushed into a new category. If you're single and make more than $25,000 a year, or married and bring in more than $32,000 together, part of your Social Security gets pulled into the taxable column. And if you cross the next threshold, $34,000 for singles, or $44,000 for couples, then up to 85% of your benefits can be taxed like regular income. Now let's pause for a second, because that number is staggering. 85%. Imagine getting a check for $1,500 a month, only to find out more than $1,200 of it counts as taxable income. That's not pocket change, that's real money disappearing before it ever reaches your hands. And think about how unfair that feels. You paid income taxes when you earned that money years ago. You paid payroll taxes every time you saw FICA taken out of your paycheck. You paid Medicare premiums along the way. And now, in retirement, the IRS comes back for another bite. It's like buying a meal, paying the bill, and then being told you owe again for the leftovers. Most retirees never see this coming until it's too late. They think Social Security is a guaranteed income stream, only to realize Uncle Sam still has his hand in the pot. And here's the kicker: the federal system is just the beginning, because many states use those exact same income thresholds to decide how much more of your check they can grab. And that brings us to the real gut punch: the 12 states where your Social Security isn't safe at all. Let's name them, one by one. Chapter 2. The 12 states exposed, so let's get straight to it. There are 12 states where your Social Security benefits can still be taxed. They are Colorado, Connecticut, Kansas, Minnesota, Montana, New Mexico, Rhode Island, Utah, Vermont, West Virginia, Nebraska, and Missouri. If you live in one of these states, your check may not be as safe as you think. Now, here's what makes it even more frustrating. The rules aren't the same everywhere. In some states, like Nebraska and Kansas, your Social Security is treated almost like regular income, which means a big chunk of your check can vanish if you're over their income limits. In other states, like Connecticut or Rhode Island, the tax only kicks in if your income crosses a certain threshold, but once it does, you're suddenly hit with a bill you didn't plan for. And then there are states like Minnesota and Utah, where the formulas are so complicated that even tax professionals shake their heads. You could be sitting at your kitchen table, pencil in hand, looking at your benefit statement, and still have no idea what the final number will be until tax season comes around. That uncertainty eats away at your peace of mind. Think about this. 2 retirees with the same Social Security check, living only a few miles apart, could walk away with completely different amounts of money at the end of the month just because one side of the state line taxes benefits and the other side doesn't. Geography alone can decide whether your retirement feels comfortable or squeezed, and the impact is bigger than most people realize. We're not just talking about a few dollars, we're talking about hundreds, sometimes thousands, gone every single year. Money you thought you could use for food, prescriptions, or time with your grandkids, redirected straight into state coffers. And here's where the real shock comes in: how much of your monthly check can disappear before you even realize it. Let's break it down in dollars and cents. Chapter 3. How much of your check disappears, so how much can these state taxes really take from you? Let's put it into real numbers. Imagine your Social Security benefit is $1,800 a month. That's about $21,600 a year. In a state like Nebraska, if your income pushes you past their limit, a portion of that check gets treated just like regular income. Depending on your tax bracket, you could see $100, $150, or even $200 vanish every month. That's more than $2,000 a year, gone before you even know it. Now think about what that money represents. That's your grocery bill. That's your utility payments. That's the difference between being able to cover your prescription costs in full or having to stretch your budget just to get by. It's not just numbers on a tax form, it's your quality of life. And the hit isn't always predictable. Maybe one year you manage to stay just under the income limit and your benefits escape state taxation. But then the next year, a required minimum distribution from your IRA pushes you over the line, and suddenly your Social Security is taxed too. Same lifestyle, same spending habits, but now your check is smaller, and the only thing that changed was the calendar. This uncertainty is what makes it so frustrating. You can plan your retirement budget down to the penny, only to watch it shift because of state rules you had no control. And for many retirees, that surprise doesn't come until tax season, when the refund they were counting on turns into a bill they never expected. So the real question is this: why do these states do it? Why go after retirees who have already paid their dues? The answer lies in one word: revenue. Chapter 4, Why States Do It. So why did these 12 states reach into your Social Security check in the first place? The answer comes down to one thing: revenue. States are constantly looking for ways to balance their budgets. They need money for schools, highways, public safety, healthcare, and all the programs that keep the government running. And with more retirees than ever, Social Security benefits start to look like an irresistible source of extra tax dollars. But here's where the frustration really sets in. From your perspective, it doesn't feel like shared responsibility. It feels like punishment. You've already paid federal income tax when you earned that money. You've paid payroll taxes every time FICA was taken out of your paycheck. You've paid sales taxes on nearly everything you've ever bought. You've paid property taxes, gas taxes, and sometimes even state income tax on top of all that. And now, after decades of doing your part, the state comes back for one more bite out of the same paycheck. The justification these states use is always the same: we're only taxing higher income retirees. But let's be honest, the bar for higher income isn't nearly as high as they make it sound. In many of these states, all it takes is a modest pension, a small IRA withdrawal, or even a part-time job to push you above the cutoff. Suddenly, you're lumped in with the wealthy elite, when all you're really doing is trying to cover your bills and keep your independence. Picture this: you've worked your whole life, you've saved carefully, and you've built a retirement income that feels comfortable but far from extravagant. Maybe between your Social Security, a small pension, and some savings, you bring in around $50,000 a year. That's not luxury living. But in some of these states, that income is enough to trigger extra taxes on your Social Security benefits. It's as if being responsible and planning ahead is now being treated like a crime. And here's the cruel twist: the people who get squeezed the hardest aren't usually the wealthiest retirees. They can afford tax professionals, and they've got enough assets to absorb the hit. No, the ones who feel it most are the folks in the middle, the ones who don't qualify for special exemptions, but also don't have millions tucked away. The people who worked hard, followed the rules, and did everything right, only to find themselves caught in the crossfire. So who exactly takes the brunt of this? Who gets hit the hardest in these 12 states? That's where we're heading next. Chapter 5, Who Gets Hit the Hardest. Not every retiree feels the sting of these state taxes the same way. Some people skate by with little or no impact, while others see their Social Security check shrink dramatically. So who gets hit the hardest? Let's break it down together. The first group is middle-income retirees, and I want you to hear that clearly: not the wealthy, but the middle. If your income is too high to qualify for exemptions, but too low to easily absorb the loss, you're stuck in the worst possible spot. Imagine you're bringing in between $45,000 and $55,000 a year. That might come from Social Security, a modest pension, and a few small withdrawals from your IRA. It's enough to keep your bills paid and give you a little breathing room, but you're not living in luxury. Yet in states like Kansas, Nebraska, or Minnesota, that level of income is enough to trigger their tax on benefits. Suddenly, hundreds of dollars that you counted on for groceries, utilities, or gas are siphoned away every year. The second group is retirees with pensions or retirement account withdrawals. And this is a big one, because so many of you worked in jobs where pensions were the backbone of retirement. Here's the trap: every time you pull from your IRA or 401k, every pension check you receive, that income stacks on top of your Social Security. The more it adds up, the more likely your state is to declare a chunk of your Social Security taxable. You're not doing anything extravagant, you're simply living off the retirement plan you built, but the state punishes you for it anyway. And then, perhaps the most heartbreaking group, widows and widowers. When one spouse passes away, everything changes in an instant. You go from joint filing to single filing. The income thresholds for taxation drop, but your expenses don't. You still need heat in the winter. You still need food on the table. You still need to keep the lights on. Yet the same Social Security that was once safe for a married couple can suddenly be taxed for a surviving spouse. It's a cruel twist just when life has already dealt you the hardest blow. The tax code steps in and takes more from you. So if you're middle income, if you rely on pensions or retirement account withdrawals, or if you've lost a spouse, you are exactly the kind of retiree these 12 states end up hitting hardest. And here's the truth. These are the people who played by the rules. You worked, you saved, you built a life where you weren't asking for handouts. And yet you're the ones caught in the crossfire. But here's where the story shifts. You're not powerless. You may not be able to rewrite state law, but you do have options to protect yourself and soften the blow. And that's exactly what we're going to cover next. Chapter 6. What you can do about it at this point. It might feel like there's nothing you can do. If you live in one of these 12 states, you might think you're just stuck paying whatever tax bill they hand you. But here's the truth, you're not powerless. There are smart ways to protect yourself. Sure, you can't rewrite state law. You can't walk into the Capitol building and demand they stop taxing retirees. But you can. Take control of how much of your income falls into the taxable column. And the difference between planning ahead and ignoring the rules could be thousands of dollars every single year. Here's how you do it. First, know your state's exact rules. Some offer age-based deductions, some give partial exemptions once your income falls under a certain level. If you don't know what's available, you're leaving money on the table. Second, manage your withdrawals. Every dollar you pull from a 401k or IRA can push your Social Security into taxable territory. By timing those withdrawals or shifting some savings into Roth accounts, you can cut your tax bill. Third, use every exemption you qualify for. States like Colorado and Utah offer credits once you reach certain ages. Don't let those slip by unnoticed. And finally, relocation. I know this isn't possible for everyone. Family ties, healthcare, and cost of living all matter. But the reality is simple. The majority of states don't tax Social Security at all. Moving just across a border could mean the difference between keeping your full check or losing a piece of it year after year. Because here's the bigger truth, this fight isn't only about these 12 states. It's about your entire retirement future, and how much of your money you actually get to keep. So here's what you now know. There are 12 states where your Social Security benefits are on the chopping block: Colorado, Connecticut, Kansas, Minnesota, Montana, New Mexico, Rhode Island, Utah, Vermont, West Virginia, Nebraska, and Missouri. If you live in one of them, your retirement check isn't as safe as you once believed. You've seen how federal taxes already eat into your benefits, and how state taxes pile on top to create a double whammy. You've seen who gets hit hardest: middle-income retirees, widows and widowers, and anyone pulling from pensions or retirement accounts. And you've seen the steps you can take to fight back, knowing your state's rules, managing your income, grabbing every exemption, and yes, even considering relocation if it means keeping more of your hard-earned money. The punchline is simple. If you live in one of these 12 states, your Social Security isn't safe from state taxes. But now you know exactly what's happening, and you won't be blindsided when your check shows up smaller than expected. You worked for these benefits. You paid for them every single paycheck of your working life. You deserve to keep them. Don't let hidden taxes steal what you've earned.